The Johannesburg Stock Exchange increased its annual dividend and grew profits despite a tough environment characterized by a wave of delistings last year. Operating income grew 6.9% as it increased the proportion of its revenue derived from non-trading activity. Now, the share price was up about 3%, but has fallen more than 15% in the past year. SABC Markets presenter Nastassia Arendse spoke to the CEO, Leila Fourie.
We delivered strong performance against a very challenging macro backdrop. Our headline earnings per share were up 12.2%, and our net profit after tax was up 11%. We delivered a very resilient revenue profile, which was up 6.9%, and that was despite equity trading volumes, which is our biggest market, down by 9.5%. This was ahead of analyst expectations, who were either in the negative or the low 2% range. And the revenue growth that we saw was really supported by a diversification of different trading assets, so bonds, equities, derivatives, and then also by new business units or by growing non-trading business units. We generated very healthy cash, which was up by 13.6%. And all of these results were really supported by the implementation of our strategy, which involved modernization of technology and processes and partnership with large and well-known partners. And so we are really focusing on delivering innovation through fast through partnerships.
We'll get to the diversification strategy in a bit. I wanted to get your perspective on investor sentiment towards South Africa. What are you reading here?
Nastassia, investor sentiment is a function of the global macro backdrop as well as South Africa. Globally speaking, the investor sentiment has been what we call risk off, which is investors are not really investing in emerging markets at the moment. We are starting to see a turn, and in fact, the Federal Reserve in the US are about to announce their rates, introduce their rate announcements in the next day or two. And if those rate announcements are positive, either the rates are coming down or they're about to come down, investors will start to invest back into emerging markets. Emerging markets are the assets that create more yield and more returns than the developed world. In South Africa, there's a bit of a wait and see around the elections. Investors internationally are waiting to see how the elections play out. In the event that the elections don't disrupt the country, there is likely to be an increase in investment into our markets. And then the other factors on the ground, like how we're doing on logistics, our ports, our port management, our electricity crisis, job creation, growth, those are all very important factors to attracting flows.
When it comes to the diversification strategy that you spoke about, in terms of what we're seeing when it comes to trading revenue, what's the next step here? Because, it's quite interesting to see how much it's grown, now contributing about 36.8% up from 29% in 2019. What's the next lever here of growth?
So we've taken an approach of both growing organically and inorganically. Organically, we are starting to sell market data in a very different way. So all the data that you would see on Bloomberg and Reuters terminals comes in various forms, and we provide analytics tools that creates a much easier way to interact with the data. We've introduced what we call a data lake, which has all the data in the cloud, and it enables traders and market participants to access that data in a much more user-friendly manner. We are also increasing our investments into inorganic companies. We bought Link Market Services, and Link Market Services has grown by 20% in revenues over the year. Our compound growth rate over since we acquired it is more than 60% on net profits. So we are planning to continue to invest in market data. We will continue to invest in our technology and building out an ecosystem like our co-location center, which will provide our traders with a cheaper and easier way to connect to the trading engine. And we will continue to look for potential acquisitions that can introduce new sources of revenue that buffer us against the cyclical ups and downs of trading volumes and values through the cycle.
Leila, the last time you and I had a conversation, we were talking about investigating the feasibility of an alternative digital offering. Where are we with that?
So last time we spoke, we had just delivered what we call Project Coca, and that was enabling participants to trade tokenized assets. So you have a token that you use fungibly to trade between an equity and a debt instrument. We are now launching a digital assets market project, which we are looking at how we can investigate different kinds of digital assets in the market. It's really at its inception. We still got a way to go, but it's really taking what is currently our existing market and making it more digital.
As we wrap up, Leila, when a lot of your peers, say, for instance, the president of the New York Stock Exchange or those who are running the Nasdaq, they often talk about an active capital markets. To what extent is that predicated on central banks cutting interest rates?
Central banks globally cutting interest rates are a very important source of international flows into the country. And so when the central banks start cutting interest rates, emerging market investors take their money out of what they call safe havens, which would be the American dollar, the American debt system, and they start to invest into emerging markets like South Africa, Brazil, Mexico, even India or China. And as they start cutting rates, we are going to see money starting to flow back into our emerging markets, which is why it's so important for us to be ready to attract those. And in order to do that, we've partnered with a number of technology solutions. We've just announced today a collaboration with Amazon Web Services, where we will be providing cloud-based services to enable flows to be more efficiently processed when people trade on our market.